Hello and welcome to financialspreadbet.com. My name is Stu Wisson. In this article we're going to talk about what is technical analysis. Technical analysis is a method of analysing financial chart data that is represented in varying forms, depending on preference and technique, to allow a trader to gauge the market history and current activity, to assess the opportunity for trade entry, projected profit, and exit. As an aside, there are two camps in analysis, technical and fundamental. I'll be writing about fundamental analysis in another article. Now, despite devotees in each forms of analysis, it is considered good practice at least to take some form of fundamental analysis as part of, say, a longer-term trading position, and the same is true for fundamental traders to look at the technical charts to analyse the current markets. Now, when one hears the words technical analysis, it conjures up an image of something that is inherently technical and requiring an aptitude for finance, figures and accounting to be able to understand the business and so on. Inasmuch as any form of that knowledge is useful, it's not actually critical to understanding technical analysis. In fact, I'm going to go out on a bit of a limb here and state this. Technical analysis is not actually technical at all. Most of the technical aspects are done for you. What I would prefer to call technical analysis is in fact visual analysis, as the computer uses algorithms to present the information to you in particular ways, depending on preference and the method of analysis used. It is up to your ability and your understanding of analysis to visually look at the chart and assess whether that stock, for instance, is worth trading on. Various overlays can be added to any chart to show given speed of growth or decline, to represent the amount traded and how quickly, to gauge current upward, bullish or downward bearish trends. Just as a quick aside, there will soon be a complete free training course on both spread betting, but more so the use of technical analysis and how to apply that. This is going to be a full and complete course to enable you to begin trading with confidence, and what's more, it will be completely free. Okay, back to the story. Analysis is neither technical nor difficult, but does require skill and take a while to learn. One of the key mistakes that a novice using technical analysis for the first time is that some believe that technical analysis has the ability to predict future price movements. This is impossible. No matter how powerful computers become, how clever the software that is written for them, this is simply not possible. What technical analysis does give you is the ability to use well-known methods. This could be anything from forms of pattern recognition as applied with Japanese candlestick charts, or OHLC, open, high, low, close charts, that based on many years of analysis, certain patterns that are usually very loose in interpretation can sometimes suggest possibilities for movement in a given direction. There are also what are known as additions called indicators that represent an aspect or a combination of data that shows this in a new way within boundaries, which can suggest positions where the market may begin to slow down or speed up. Further, there are overlays which have with overlaying aspects you can add to a chart, such as widely used moving average, which is a lagging indicator taking an average of the closing price of the market at a set number of days. Say, for instance, a 20-day moving average will plot the last 20 days closing prices of the chart as a line. A combination of these moving averages are a very common indicator to show possibilities of where the market is changing trend, for example. Now, talking of trends are by far the most common and possibly the key aspect of any form of analysis that you should first apply. In fact, trading is littered with sayings, and here is one I'll present with you, by far the most common, and one which, in fact, you shouldn't ignore. In fact, I can assure you that I'll be saying this many times over in the training course later. Let the trend be your friend. Essentially, this means if the trend, the overall market movement in one direction or another, is up or bullish trend, or down, a bearish trend, is going up, for instance, has been overall for weeks or months, it would be foolish to trade in the opposite direction. Certainly if you look to take longer time scale positions of days or weeks. There are many, many, many tools and techniques, methods and practices in technical analysis. In fact, in 2009, I wrote a complete training course in analysis called the Master's Certificate in Technical Analysis. I am in the process of completely rewriting that from the ground up to make it easier to understand, make it more open, and to breathe in new methods, considering a great deal has changed in the markets over the last few years. I'm going to give you this course that was marketed as initially at a silly amount of money, absolutely free. Oh, and just one quick word. I am British, so some of my spelling may seem somewhat odd to my American cousins, such as analyzing with an S rather than the American spelling of analyzing with a Z. You wouldn't believe over the years that I've been writing about analysis. After all, this is what I'm known for writing about. How many people write to me over the years stating that I'm spelling certain words incorrectly? Now, there, glad we got that out the way. So let's carry on. Analysis then allows for a trader to take information from the trading of a particular item and use that historical data to be presented in different forms, to allow for a method of analysis to be undertaken. A key point I want to point out here is which basically reinforces what I was saying earlier about analysis not being able to predict the future, is that analysis only uses historical data and presents that data in a particular way. A result of this, 99% of all indicators and methods are only showing you what has already happened. Let me basically repeat that, and so it's very, very clear. Indicators and all the others only show you what has already happened. Algorithms are applied to the data to represent it in a particular way, which, depending on the algorithm, is read a particular way and represents either a change in momentum, the speed of the growth or a decline of the chart, or provides some form of average lineage representation, all of which are read in particular ways. Now, for just one article, it's impossible to give you a full idea of what analysis is about. Certainly there is no chance for teaching you about analysis in just one article. But do remember, of course, to look out for the free course. However, if you need to take anything from this article, it's that technical analysis is not, in fact, technical. It's more visual. That all technical analysis can do is represent historical data in a particular way that makes it easier to understand what may or may not be happening with the market, and through a great deal of understanding for the method of analysis that you are using, and there are plenty, many of which we will cover, I promise you, they allow you to judge price movements, entries, exits, and project potential profits. This is all that analysis can give you. It is not a crystal ball that allows you to see into the future.